This video will help you avoid missing any required minimum distributions. If you don't know who I am, my name's Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Due to recent retirement account legislation changes, such as the Pension Protection Act of 2006, the Secure Act of 2019, and the Consolidated Appropriations Act of 2023, also called Secure Act 2.0, it's been nearly impossible to keep up with all the changes for retirement accounts relative to things like deadlines, penalties, and other onesie-twosie administrative things to know, unless financial planning is your full-time job. So in today's video, I thought we'd cover the basics of RMDs, including their deadlines, respective penalties, and some courses of action to be aware of. So let's jump in. As a quick refresher, required minimum distributions are annual mandatory amounts that you must withdraw from a retirement account. And if you forget to take out your mandatory allotment, you will face IRS penalties and then still need to make that withdrawal. Unfortunately, the calculation to determine how much you need to pull out of your retirement account changes every year because it's based on the account balance of December 31st of last year. And then it's multiplied by a factor that the IRS puts out, which essentially relates to how much longer they think you're going to live. So since those two variables change every year, so does your required minimum distribution. To add more complexity, there's different rules as it pertains to pre-tax versus Roth retirement accounts. There's different rules as it pertains to inherited pre-tax versus inherited Roth accounts. And there's even different rules on which types of accounts can be pooled together, so you only have to take out one required minimum distribution versus needing to take out an individual required minimum distribution from each individual account, even if they're all pre-tax. But we're gonna avoid all of this nuance and just stick to the basics. If you do want some of this nuance explicated, just drop it in the comments below or send us a message to the website and we can incorporate some of that more nuance in future videos. Long story short, if you have a pre-tax retirement account on your balance sheet, like a 401k or an IRA, unless you die, you will eventually need to withdraw required minimum distributions from these accounts. And you won't get hit with them until you're in your 70s for retirement accounts that you own. And technically, even if you do die, you might still owe the IRS a required minimum distribution. More on that later. And as mentioned earlier, as it pertains to inherited retirement accounts, these required minimum distribution calculations also extend to anybody who could inherit a retirement account. And since theoretically anyone can name you as a beneficiary in their retirement account, whether you know about it or not, it would behoove you to be aware of some of the basics as it pertains to required minimum distributions. That way you can have it in your back pocket if other folks need help and you can help them, or at a minimum, help you avoid some unnecessary tax penalties. In addition, I can tell you from experience that as clients age, required minimum distributions become a greater and greater thorn in their side, not only because as they approach 70, they have to worry about this and there's some planning you should probably be working on ahead of time, but also as folks age, their loved ones pass away and these retirement accounts pass on to the next generations. Which, when IRAs pass on to the next generations, required minimum distributions are a must, whether or not they're in their 70s. So let's cover the basics for those who are approaching required minimum distribution age territory in their 70s, or for those who might inherit an IRA well before their 70s. So no matter what type of retirement account you get or what type of required minimum distribution schedule you're on, required minimum distributions are due to be withdrawn by no later than December 31st for whichever tax year is in question. There's one exception to this rule. For whichever year they turn the age that now starts the required minimum distribution schedule, they are allowed to defer withdrawing their first required minimum distribution to April 1st of the following tax year. Now that does mean that in that next tax year, they'll essentially have two required minimum distributions that they'll need to withdraw. One for the tax year that's currently in question, and then one for the previous year that they deferred till this year. As a quick refresher on required beginning dates, those are the dates in which you have to start taking required minimum distributions out of your own retirement account. So after the passing of the Secure Act 2.0 at the end of last year, there were some updates as to which ages needed to start taking out required minimum distributions at different dates. So I'll clarify those dates right here. So if you were born in 1960 or later, your first required beginning date is going to be age 75. Keep in mind, just because you turn age 75 in that year doesn't mean you have to take the RMD in that year. You can always defer the first RMD to the next year, but the deadline for that first ever required minimum distribution that you defer is by April 1st of the following year. So said another way, you can defer your first RMD to the following tax year, which technically makes that next year your required beginning date. I know it's confusing. Okay, now if you were born between 1951 and 1959, your required beginning date is the date you turn 73. That tax year is your first required beginning date. Keep in mind though, you can defer that RMD again until April 1st of the next year. And then lastly, for folks who are born in 1950 or earlier, your required minimum distribution beginning date, or RBD, is when you turned 72, unless you turned 70 and a half before 2020. I know that's confusing as well. If you have questions, drop them in the comments below. But ultimately, there was sort of like a phase-out period that took place when the Secure Act 2.0 was updated, so it changed some of these rules. The key takeaway, though, is your required beginning date is the year that you must take out a required minimum distribution, which can be the year after you turn the ages I just mentioned, because you can defer your first required minimum distribution. Now, normally tax deferral is a great benefit, but it may or may not be in your best interest to do this because as you push out taking the withdrawal, that means you have to take a much larger chunk of your account balance out in one single year, which from a marginal tax bracket standpoint might not be in your best interest. Now, whether you inherit a retirement account and now you have to pull out your own required minimum distributions, or you're in your 70s and now you have to start taking out required minimum distributions for your own accounts, if you fail to take out a required minimum distribution by December 31st, minus that one exception we talked about, you will face a penalty tax of 25% of the undistributed balance. Ouch. Said another way, you will have to send a check to the IRS for 1/4 of the total amount of required minimum distribution you failed to withdraw. Then you'll still need to take out whatever dollar amount the required minimum distribution equated to. Now, this penalty tax used to be 50%, but thanks to the Consolidated Appropriations Act of 2023, this penalty tax went from 50% down to 25%. And the IRS says you can further reduce that 25% penalty tax down to 10% if you remedy the situation within 2 tax years. And on top of that, the IRS says that there's a possibility that you can waive the missed required minimum distribution tax penalty if you can show that the missed required minimum distribution was due to reasonable error and you remedy the situation by taking reasonable steps. The IRS then recommends you file Form 5329 and attach a letter of explanation as to what's going on. I've seen this strategy employed mostly for the situation that I'll describe here next. So now remember when I said that even if you die, you still owe your required minimum distribution? Let's talk about how to treat required minimum distributions in the year that you pass away. Well, you won't have to deal with it, but your beneficiaries will. So it's still the case that a required minimum distribution is due by December 31st of that tax year, which technically means, yes, if you die on December 30th, technically your beneficiaries are charged with removing the required minimum distribution from that account in one day to avoid any tax penalties. This is simpler if there's only one beneficiary that has to deal with making sure that the correct amount of required minimum distribution was withdrawn and the subsequent income taxes are paid on their return. However, if you elect multiple beneficiaries, it gets a little bit complicated because now all the beneficiaries need to coordinate, because if they're not coordinating, there's a chance that too much is going to be withdrawn from the account or too little, and therefore they'll end up either overpaying the IRS or underpaying, and that could lead to some tax penalties. Technically, the IRS doesn't care which of the multiple beneficiaries takes out the required minimum distribution or in what combination it's all withdrawn and the taxes are paid. They just want to see that the amount of money that they say you needed to take out by December 31st is withdrawn. They don't care about which combination of beneficiaries do it. To clarify, this required minimum distribution and the subsequent income taxes are not paid by the decedent's estate. It's up to the beneficiaries, which are generally people, who must withdraw the required minimum distribution if it wasn't already, and pay the subsequent taxes on their own income tax return. Rest assured, handling this correctly, especially when it's a very short time horizon, has led to a number of mistakes by beneficiaries and a number of missed timelines. So the IRS extends some grace, and there's an automatic extension to remove the required minimum distribution, and that deadline is the deadline for the beneficiaries to file their income tax return, including extensions. So theoretically, if you die on December 30th, in a perfect world, your beneficiaries would withdraw your required minimum distribution in one day, but it's not likely, and they have until April 15th or October 15th if they extend to make sure that all the money is withdrawn that it was supposed to be done, and that they pay the respective income taxes on that withdrawal. If you're a beneficiary and you're dealing with an inherited retirement account, after the date of death, required minimum distribution is withdrawn and the subsequent taxes are paid, odds are you are going to now be on a required minimum distribution schedule of your own. And the rules for that beneficiary's required minimum distributions are very specific. And those beneficiaries are broken up between eligible designated beneficiaries, non-eligible designated beneficiaries, and then non-designated beneficiaries. I know those are all probably new terms, but I've got some future content coming out that explains those and breaks them down a little bit. So just stay tuned for the next few weeks and we'll be able to break those down. But the point is that each one of those beneficiary classifications have their own required minimum distribution rules. So first you'd have to identify which beneficiary camp you fall into, and then you'd have to further fall into the camp of understanding whether the individual met their required beginning date or not, and that'll ultimately dictate which schedule you're on for mandatory withdrawals. So what are some courses of action here? At a minimum, if you're approaching your 70s, it pays to be aware of these required minimum distribution rules. Being aware can help you avoid paying unnecessary tax penalties, and if you're proactive enough, there are some strategies that you can employ that remove the necessity to pull out required minimum distributions and or can help you achieve a much more tax efficacious estate that you can pass on to the next generation. In addition, it's probably in the best interest of whichever beneficiaries you have listed on your account to make them aware that money will be coming to them in the event that you pass away. Now, you don't have to disclose the total amount of the retirement account if you don't want to jeopardize any sort of financial education you're trying to provide the next generation, for example, but you should at least disclose to them that something will be coming, and when it does, here's their course of action. What do you know that telling the next generation what to expect ahead of time generally is a superior financial strategy than what I'll call is surprise estate planning. And surprise estate planning is where I see the majority of mistakes occur from a tax standpoint and a mismanagement of the family's wealth. If you find yourself in missed required minimum distribution territory, whether it's for your own retirement account or it's a retirement account that you inherited, keep in mind, if it's your first required minimum distribution that you have to pull out because now you're in your 70s, you have until April 1st of the following year to pull out your first ever required minimum distribution. That's a little saving grace there. On top of that, if you're a beneficiary and you inherit a retirement account and you forgot to take out the year of death required minimum distribution, you have until your tax filing deadline to see that through to fruition. And that's an automatic extension. So I hope that was helpful in helping you avoid paying the IRS more in penalty taxes than you'd ever have to. Of course, if you have questions, drop them in the chat below or get in touch on the website. Hope you have an awesome rest of the week. We'll chat with you later. Bye.